Uh, Good afternoon, everyone. So, sorry for having to skip the break. I'm sure you'll enjoy this particular talk. We've got with us, I'm really honored to, you know, present Mr. Mahalingam here, who's there with, whom the session is going to be moderated. He is a rare combination of being with two regulators, being a career central banker. He has been an executive director with the central bank, the RBI, and on the forex side, and then later on he was a whole-time member with SEBI. So, I mean, he really doesn't require an introduction, but just a small gist of what he has. He's had a 40-year long career, and I'm sure we will learn so much more, including me, how much in this 1 hour that we have. So, Mr. Mahalingam, please welcome on stage.
Thank you, Poonam.
It's an honor, sir.
Thank you.
Sir, currently we are seeing that monetary policies of all the countries, major economies in the world are facing the same kind of problems. All of us are having, high inflation and everywhere, almost the entire world. Maybe it is the pandemic and, whatever the problems with respect to the pandemic, all of us are facing similar problems. So how do you see the monetary policy panning out, given that we just had one number of inflation coming out still higher, and even the US has had the same thing. Of course, they had a 40-year high inflation, but we've also had, I think, almost a 8 or 10-year high inflation. So how do you see it going forward?
Pretty interesting question, but of course, one has to make a huge amount of guesswork as to what the monetary policy holds out right now, whether it is across the world or even if it is India. Across the world, I think we are seeing a huge traction of inflation. I think the numbers that have been put out by US yesterday of 8.2%, I think it's a clear case of unrelenting inflation in US. It's just refusing to come down. We can get back to, I think, what the central bankers did there till some time back. But prior to that, let me also tell you that it's not just inflation in US alone, it's inflation in Eurozone, inflation in Britain. Britain, of course, has messed it up royally, of course. I think they need a special class to mess it up in that way. If you look at the emerging market economies, I think the emerging market economies are also in the same boat. I can't really cite one economy today which is in a comfort zone as far as inflation is concerned. Let me now come to a little bit, just to elaborate on the point that Poonam was addressing. How is it going to pan out? Now, I would like to look at how is it going to pan out across the globe, how is it going to pan out in India. Across the globe, I think we have pretty little clue. Now, the way Jerome Powell has taken off, he says whatever it takes, he is going to really kill inflation. So, basically, which means after this 8.2% data point yesterday, clearly the December FOMC, I think we can expect at least 50, if not 75. And this 75, if it comes through 4 into 75, 300 is a kind of a record for US. It has never happened in US at all. As far as Eurozone is concerned, Eurozone has already got into the trajectory of increasing. So, again they are not going to stop, they are going to go further. Britain, of course, is going to be a different cup of tea, as I was mentioning. Now, come back to India. India again, we saw the rates typically going up from 3.35 to the present level of 5.90. Although people talk about 190, 200 basis points increase, I will actually put it as 3.35 to 5.90, which means clearly almost about 2.5% increase, because at that time the reverse repo was the real operating rate and today repo is a kind of an operating rate. So, question is now how far India can go. Now, this is going to be literally $1 million question. I mean, how far India can go? Can it actually increase the rates by another about 50 basis points? More than that? Now people are talking about a terminal repo rate of almost about 6.5, but I am sure this number is going to get revised now. Now again, after the inflation figure that has been put out, after Reserve Bank has said that inflation will be seen to be easing now, we have reached a peak. This is what the governor of RBI said. I am sorry, actually two guys from RBI are sitting there, and I will continue to be impartial towards RBI also. Wherever I need to criticize RBI, I will continue to criticize RBI or SEBI for that matter. So I find that actually perhaps RBI's inflation projections are not really on the mark at all. They are quite off the mark, and once they said that the April 7.8 figure has been touched, we are never going to actually go to the higher territory. But now what is really unnerving is that the food inflation as well as the vegetable prices inflation, they are gaining traction. How is it going to pan out in the next, as the winter comes in? Again, that is for us to guess. But as things stand now, the inflation appears far stickier than what the RBI is estimating it to be. Whether it is going to come back to the trajectory of 4 plus or minus 2, which the Reserve Bank is expecting by about 2023 in the second to third quarter, again I think it is going to be a huge amount of guesswork. I am personally, if you ask me, while it can happen because of a variety of reasons, there are equally strong reasons why it need not happen also. Now, the prime driver of inflation here is number one, the oil prices, number two, the geopolitical situation, which is actually creating a supply chain issue and all that. Now, these two issues, I doubt whether they are going to go off in a hurry. They are going to stay stickier. So, given that if you are going to continue to import oil at somewhere around $85 to $90 a barrel, I do not see much of chance of inflation coming down in a hurry, at least not in just about 6 months time. So, it could take quite long, which means we could see of 23 being out of the range of 4 plus or minus 2, which is going to be pretty unnerving. And if Reserve Bank is going to hike the interest rates by another 50 basis points and puts out a guidance which is, I mean, a bit hawkish, the market will factor in another 50 basis points very easily. So, which means we are not going to stop with a terminal repo rate of about 6.5, which is the guesswork of some of the economists now. So, we can go well past 6.5. So, this is in brief about the panning out of the monetary policy, but there are other factors surrounding it which I will come to if there are some things, I mean, if Poonam is going to ask me questions which will kindle further thoughts on my part.
Fine, sir. So I agree with you. I mean, especially with the services being so sticky, once somebody raises the rate for a service, they never come down. So
Yeah.
it becomes even worse. So once it translates into the secondary part of it, it's very difficult for it to get pushed out. Secondly, sir, all the IMF and all others all over the place are saying that India is a bright spot in the economy, and they say that, you know, like this is the only one economy where they find, you know, that growth is going to happen and so on and so forth. So in that case, what do you feel that India is insulated vis-a-vis the rest of the world, or will there be some spillover from the other countries?
That's again a pretty very important question. While on the one hand we can actually take pride in the fact that we have been growing and we will continue to grow, say at about 6% or so. 6% today by Indian standards is pretty low, but by international standards I think we are far better than any other major economy that can be counted on. So, given that kind of a situation, even 6% growth if we are able to achieve, I think it is fantastic by the global standards, no doubt about it. But the question that we need to really look at is, are we standing insulated? Are we a kind of oasis in a kind of a desert where actually the growth is not taking place at all? Now, to answer this question, there are again, we need to go back to the factors that we were just discussing in answer to in response to the first question. Now, when we say that India can stick on to a growth rate of say about 6.5 and later the trajectory can pick up, again it needs a lot of facilitating factors. Now, thankfully, the Indian story is made up of a good part by domestic demand, and the domestic demand traction continues to be good. But then India is not something where actually the export part of it or the external sector can be completely kept out and say that, look, we are going to go only on the strength of the domestic demand completely. That's not going to happen. Now, if the US is going to falter, Europe is going to falter, now which means basically your exports are not going to see a big takeoff at all. So, to that extent, the GDP is going to get affected quite significantly. So, given that kind of a situation where the world around us is not growing at all or growing at a very slow pace, we cannot get completely isolated from that. So, to call that India is going to be a complete oasis and perhaps the growth is going to be continuing at a trajectory of 6 to 9% over the next about 3-4 years, I will be finding it very hard to subscribe to that idea. I would continue to say that if we record a growth of about 6% in the next about couple of years, I think good enough for India. Then we will need to wait for the whole world to actually come out of the kind of recessionary trends that they are getting in. Once US gets out of the recession, perhaps there is much scope for better growth as far as India is concerned. So, my answer to this question is yes and no. India stands at a better growth trajectory compared to the rest of the world, but India is certainly not insulated.
So we still require the US to grow better.
Yeah, right,
so that
absolutely.
we can grow much higher.
Yeah, right.
Okay. Sir, since you've been associated with the RBI for so long, we would like to know your views on what are the dilemmas which the RBI faces in conducting the government borrowing program.
One is, of course, very clearly the government borrowing has been on an upswing.
Yes.
Borrowing 50 lakh crores a year is a colossal task, and to make that happen without the bond market actually completing going out of shape is something, again, it's a kind of a miracle actually. Now, there are lot of consequences of this, but let's look at actually the dilemmas that Reserve Bank is going to face. Now, in response to the first question of Poonam, I was saying that Reserve Bank perhaps has no other go but to raise the interest rates. Now, I talk purely from the monetary policy considerations. There is another massive consideration at the back of mind of RBI. Now, if India cannot keep pace with US in terms of interest rate hikes, but then at least it has to have a kind of a lockstep kind of a rate increase, if not exactly in magnitude, at least in terms of steps. Why? For the reason that if the typical rate differential between India and US, which is conducive for the FPIs to come into the country, is approximately about 450 to 500 basis points. If this differential is going to narrow down, clearly the foreign portfolio investors are not going to be enamored of India at all. At least those guys who are getting into the bond market, they have no incentive to come into the bond market. Now, people are saying that, again, people are heaving a sigh of relief that the bond investors, whoever has to go out, they have gone out. So, there is nothing more to cause injury to India. I do not agree with that at all. Now, lot more money can come into India. If that money cannot come into India, certainly that is going to cause a lot of harm as far as India is concerned. There are other factors which I am not touching on right now. The current account deficit this year is clearly going to touch somewhere close to about $120 billion. And who is going to finance this kind of a massive current account deficit? This current account deficit gets financed partly through the FPI portfolio flows, FDI flows, non-resident deposits, external commercial borrowings, all these are going to come in. Now, at the present rate at which the US interest rates are rolling or the European interest rates are going to go, I think the external commercial borrowings, they have lost the taste right now, flavor right now to borrow abroad. So, keep that completely aside, which means the external commercial borrowing is one tab that we cannot rely on. Second, on the foreign direct investments, I continue to keep a lot of hope, because India has a tremendous amount of growth potential, and as long as we can remove a lot more cobwebs around whatever we have in the country in terms of the bureaucratic jungle that has been created, if we can remove that, the foreign direct investments can flow into the country in a much better way. I can tell you, I am a part of the committee which the government has appointed now on creating a conducive climate for the private equity and the venture capital, which Finance Minister announced in the last budget. And we do find that there is quite a lot of work that needs to be done. And mind you, if the venture capital, the private equity space, if it is going to get populated by more of funds coming in, the substantial part of the foreign direct investment is going to enter the country from that space, which is going to be very, very significant for the country. So, I am very hopeful about that space actually opening up. I am very hopeful about the foreign direct investment continuing to remain attractive. Now, come to the non-resident deposits. I am not sure whether this is going to really pan out well, because clearly, I mean, the non-resident deposits, when it comes into the country, people who get into the FCNRB, unless the rates there abroad are actually at a level which are very low, they do not have a great incentive to come into the country. But they are a little better off compared to NRE guys, because NRE guys are going to face a rupee depreciation problem also. They take the exchange rate on their portfolio. So, personally I feel that NRE deposits may not have that much of attraction. The FCNRB deposits again may not have that kind of attraction. On the foreign portfolio investor side, as I ruled out initially, bond portfolio, not much of a scope I see, at least for the next about 6 months. But FPI equity investors, I do see still some amount of traction coming from that end, because basically because the corporate growth, I would say, compared to again the rest of the world, I think perhaps India will pan out better. So, the FPIs are perhaps nowhere to go as far as the emerging markets are concerned. So, that way I think it is more again I mean, there is no alternative factor that will attract Indian the investments into the Indian territory as far as the equity is concerned. So, given all this, I would say that the overall traction of the foreign flows into the country is going to be a little subdued, unless we are able to create a very conducive climate to bring in more of foreign direct investments, more of venture capital investments, more of private equity investments to enter the space.
Fine, sir. Another thing is, sir, we've been hearing, so just taking from this, we've been hearing about India joining the sovereign bond index. So, in that case, money could come from that source also, right?
Yeah.
So, but every time we hear about it, for the last 3 years we have been hearing what is happening, what is impeding, what are the impediments to it, because every time they say it's coming, and then the government says no, it's not coming, and sometimes they just put it on hold. What is the real, what are the issues?
See, the major issue at the time when they commenced a discussion with India was that the entire bond space should not be constrained by any limits which we put on the foreign investors at all. They said that can you completely dismantle all the limits that you have on the bond space. Now, this is something which was not acceptable to RBI at all, for a variety of reasons. See, RBI manages a macro, and in the macro, the most important parameter that RBI will have to manage is the interest rate. The second most important factor is the exchange rate. Now, interest rate factor is going to be out of the control of RBI, because you are going to remove all the debt limits. RBI was not acceptable to that proposition at all. But then subsequently RBI came out with a proposal that we can actually relax these limits as far as certain identified securities are concerned. Now, if that is going to come through from the bond index people, I think that is fine. But then I still have, I am not a part of RBI now, but then I still have a feeling that RBI may not be completely be open to the idea that they can relax all the limits on this. Now, compare this with the parallel of voluntary retention route and the this one unlimited access route. I have forgotten the name, it is called FAR. Sorry? FAR route. Now, in this FAR route today, I would say that India has relaxed the limits, people can come in to that extent. Voluntary retention route, people have a lock-in period there. So, clearly these have been really thundering success as far as India is concerned. Now, even in a situation where the bond market is pretty subdued, if the investors are coming in hordes into these areas, I think we have done pretty well. So, my own guidance as far as RBI is concerned, RBI should not have any kind of a rethink on actually disbanding the limits as far as these identified securities are concerned. Now, let us go a step further and then examine whether RBI should completely dismantle all the limits. I am going to give you very strong arguments in favor of that. Although I come from RBI, I have spent about 3.5 decades in RBI. My feeling is opening up the limits as far as joining the bond index is concerned has much more positive factors for India and lesser negative factors. The most important positive factor, as Poonam put it very correctly, is that it is going to attract a huge amount of flows into the country. Now, what is this amount of flow? I am not too sure. Even if India gains a weight of close to about anywhere between 8 to 12% of the bond index, that can attract a flow of close to about $8 to $10 billion very easily without much of a problem at all. And now, the question is, this amount of funds which enter the country, whether they are going to be stable within the country or whether they will run away at a jiffy. Now, this is going to be a function of how we conduct our macros. If we are going to conduct the macros in a very disciplined way, I think these funds cannot simply change the weightage accorded to India on the basis of 1 or 2 parameters. Unless the entire macro of India is going to weaken, I think the weightage will not go down at all. So, people are not going to withdraw the funds in a jiffy from this kind of a index if people are once committed to that. So, on the one hand, while people may come in, going out is not going to be that easy, because only when the weights are going to be reduced, people will get out of it, otherwise people will not get out of it. Second, it brings in a huge amount of political pressure on the policy makers as well as the bureaucracy to conduct the entire economic policy in a very, very responsible way, so that ultimately people are not going to really, India is not going to pay through its nose at all. Let me add one line here, which you asked for the first question about the sovereign bond. In my opinion, that is a very, very important question to tackle. Whether this is the right time to tackle or whether it is the wrong time to tackle, well, we are open to a huge amount of debate. But let us look at this question of borrowing in the sovereign market, Indian sovereign going and borrowing in the sovereign market, whether this is good. Policy wise, I would very strongly say that India should borrow in foreign currency in the sovereign bond market. Now, let me add a little bit of checks and controls on that. Now, this was announced 2 years back in the budget, but it was hastily withdrawn. It was not even given a second thought at all. There was a huge amount of criticism by a few economists in the media saying that India is now doing the original sin of borrowing in foreign currency. Now, let me put it this way. First, let us compare borrowing in foreign currency versus FPI investment in the Indian rupee debt. I would say the one which is far more deleterious to the policy makers tackling the macroeconomic situation is FPI investment in rupee debt. Because FPI investments, once they pull out the investment, the rupee gets affected, the interest rates get affected. Whereas, once Indian government has actually floated a sovereign bond, there is no question of pulling it out before the contractual maturity date at all. After all, it may change hands. So, while it changes hands, the interest rates may spike up, but it is only the interest rate which is going to get affected. It is not going to be the exchange rate at all. That is a prime advantage. Second, people ask the question, what if you borrow in dollars and dollar appreciates and rupee depreciates heavily? Why don't you add that cost? So, should not India, after having borrowed in foreign currency, go about hedging it actually? Let me give a very straight answer to that. A sovereign cannot hedge at all. We just can't hedge. If we are going to hedge, there is no point in going and borrowing abroad.
It's like rupee borrowing.
Exactly. It is like rupee borrowing. Absolutely.
That also at a higher rate.
Absolutely. It is going to be at a higher rate because you are borrowing at the foreign currency rate plus add the forward premium. So, perhaps in today's circumstances it will work out more actually. So, there is no point in borrowing in foreign currency at all. But then if you do not hedge, is Indian government becoming a gambler? Is it actually doing a kind of, Reserve Bank is coming out with guidelines about unhedged foreign currency exposures. So, is this guideline not applicable to the sovereign at all? A sovereign, in my opinion, cannot hedge at all, because sovereign is an animal which cannot be compared to any market party. It cannot stride into the market. The moment it strides into the market, it tramples upon all the other entities in the market. So, it has to remain unhedged. Now, if it has to remain unhedged, is there an economic argument for going and borrowing abroad? Let me give you a very strong economic argument. 1993-94, the Indian foreign exchange was liberalized. We had a regime called LERMS at that point of time. Where was rupee ruling at that time? 31.37. Today, where is the rupee ruling? Close to about 82.40. If you look at the average annual depreciation of the rupee from 93-94 up till now, which is almost about 40 odd years, sorry, 30 odd years, in this period, the average annual depreciation of the rupee is just about 3.1%. But then I would say, does this actually suffice with an economic argument? India does not need to hedge at all? Yes, I would say, if you look at the average annual depreciation at 3.1%, add this 3.1% cost to the foreign borrowing cost, so certainly it will work out economical compared to what Indian government would be able to borrow in the domestic market. Leave apart the current times. Current times are completely different, because the rate differential has actually narrowed down quite a bit actually. In a normal time, when there is a differential of close to about 4.5 percentage points, certainly unhedged foreign currency exposure as far as the government borrowing is concerned does not cause much of a problem at all. Now, given that, I would say, what should the government do? Now, there are times when the rupee suddenly actually spikes down. So, suddenly the cost of sovereign borrowing will go up. How will the government manage this? It has to manage this by default by adopting a passive strategy, because on an average, if the rupee is going to depreciate by 3.1 to 3.2%, just do not bother about the zigzags in the rupee trajectory at all. If you are going to constantly borrow every year, say close to about $10 billion or $15 billion, well, that is fine. Now, look at again the budget which was announced about 3 years back. Clearly, the budget had a clause, 10% of the gross borrowing India will go to borrow abroad. I would consider that as a very, very, it is a top notch prudential measure. If the moment it is brought into a legislation, it is enacted as a part of the law, people cannot actually simply go over the line at all. Now, today in US, without a law, there is a debt ceiling which creates a lot of problem. Whereas in India, when you do that, enshrine it as a part of the law, and for the part of the foreign currency borrowing, part of the Indian borrowing, you create a foreign currency borrowing carve out, and this is going to be done year after year. Every year you go to the foreign market about 3 times, then the rupee zigzags simply do not matter at all, in my opinion.
Yeah, because in the long term, it is going to be
Exactly.
a smooth one.
Exactly.
So, yes, that gives a very different perspective, sir.
Yeah.
Because I mean, when that thing came out 2 years back in the budget, even I was a little surprised, because we had the Southeast Asian crisis.
Yeah.
And I thought about that, and I was saying, what are they doing?
Yeah.
And now this gives a different perspective. Even
Yeah.
otherwise, in the bond index, when you said that it will bring a lot of discipline to the governments.
Clearly.
So, yeah, that is a very positive point, and I think that will help, because how much can the banks keep buying SLR? How much? I mean, we do not have any more investors, or we have insurance companies. We
Right.
have a little bit of mutual funds, but that is it. How
Absolutely.
Much more, or the pension funds, how much more can they buy and they absorb? Finally, the banks have to go and lend.
Yeah.
So, you need a different class of investors.
Correct. And then you take into account the fact that even today, the excess SLR portfolio of the banks is close to about 6 to 7%.
Yes.
So, technically speaking, when the credit growth is picking up, and today if you see the difference between the credit growth and deposit growth, which is standing at almost about, say, roughly 400 basis points. Credit is growing at a clip of about 15%. Deposit
one
is
of the
going at a
highest.
clip of 9.5 to 10%.
So there's a gap.
We are going to see a looming liquidity crisis actually. So, in this kind of a situation, which bank is going to actually go and invest in the SLR securities, and certainly this excess SLR portfolio is going to get sliced down over a period of time.
So in fact, that's what the governor said, right?
Yeah.
Saying that on the liquidity side, he did say there's an excess SLR, you can go and borrow through that.
Yeah,
So
right.
so we come to the next point about liquidity. See, we saw liquidity in last 2 years was so humongous. I think it's among the highest we ever saw liquidity in so many years, 12 lakh crores, and from that 8 lakh crores, and then it has come down to minus.
Yeah.
So now, how do you see, what are the dilemmas that the RBI faces on the liquidity front? What do they do about the liquidity policy?
I think on the liquidity front, the Reserve Bank faces a maximum amount of dilemma. I mean, whether it is government borrowing, forex intervention, and liquidity. If you put it in that order, I would consider liquidity as a topmost dilemma in the minds of RBI. Now, first, as the governor of RBI very rightly put it, he wants to conduct the monetary policy in a way that the growth is not going to get derailed at all. Clearly, if the GDP is going to grow at 6%, you need supportive liquidity to actually fund the GDP growth, because without having that without having the liquidity to have grease, you cannot be actually ensuring that the economy is going to grow at all. Now, what is the kind of liquidity level that you need to conduct the monetary policy at? Typically, if you ask a old time RBI guy like me, we always say a tighter monetary policy, a tighter liquidity, a loose monetary policy, a loose liquidity. But then we have seen in the recent past, I mean, loose liquidity has been basically the slogan of not just RBI, it has been the slogan of all the central banks. So, as Poonam put it very correctly, I think from a 12 lakh crore surplus, we are now come down to 50,000 crores, or at many times, on many occasions, it has gone into negative also. So, how are you going to really tackle this situation? Now, there are two things that Reserve Bank has to look at. One, for GDP growth, you need to pump in liquidity. So, one part of the liquidity is called the durable liquidity. The durable liquidity part is going to be funded through either the forex intervention operations or through the open market operations. Today, the forex intervention operations are completely on the opposite side. We do not go and buy the dollars at all. Reserve Bank is actually selling the dollars, and by selling the dollars, Reserve Bank is mopping up liquidity from the entire system, with the result that actually instead of supportive liquidity, there is going to be more of tightness of liquidity in the system. So, Reserve Bank is doing a right thing right now by not conducting spot forex operations, but actually conducting forward forex operation. Having sold the dollars in the spot, they are doing a sell buy swap, so that ultimately the whole thing is going to the forward positions actually. So, it is not going to have a liquidity impact at all, but leave that apart. But liquidity will have to be injected into the system for the purpose of durable liquidity. So, what is the only source left? The only source is going to be open market operations. Apart from open market operation, you have the liquidity adjustment facility. So, let us assume that the durable liquidity that has to be injected into the system is some times of overall the prime reserve money which is injected. So, that reserve money injection, Reserve Bank is not going to shirk its duty. Reserve Bank will continue to do that, will pump in liquidity which is going to be durable liquidity. But that durable liquidity is going to be actually completely different from the situation that was prevailing just about 6 months back, as Poonam put it correctly, which means we are gone are the days when we are going to see 5 lakh, 6 lakh, 10 lakh crores of excess liquidity. There could be some excess liquidity in the system which will be like zigzag curve, and it will vanish the moment actually the economy corrects itself, or the government is going to accumulate a little bit of balances with the central bank. So, that being the case, all that I would say is Reserve Bank will be now focused more on the durable liquidity. On the transient liquidity, Reserve Bank will be much more conservative to leave free money along as far as the system is concerned, but to be growth supportive, it will ensure that the durable liquidity is reasonably good.
So, then but open market operations, if you say open market OMO sales, if they do that, will it not add money in the system?
You are right. No, Poonam, you are absolutely right, but then the question is, you need to open at least some tap. So, you have two tabs, forex tab and the bond tab.
Right.
So, the forex tab is remaining very firmly closed. So, you have to open the bond tab. And when you open the bond tab, you are going to open it in a very calibrated way to ensure that only the durable liquidity requirements are going to be met. Beyond that, it will not be met at all. Now, this is going to actually help the government's borrowing program.
Yes.
You asked a very important question, how is the government going to conduct the borrowing program? I think by open market operations being the sole tap which is available for the RBI to inject liquidity, a part of the borrowing program is going to get absorbed by the open market operations. Now, I for one, I do not believe that FRBM, when through FRBM, RBI was told that you can no longer participate in the primary issuance, but then the primary issuance is taking place on the one hand, Reserve Bank steps into the open market operations on the other hand. I do not understand this economics at all. I never understood this economics. Today also I do not understand this economics. So, actually you are doing a backdoor support for the primary issuance. Let us accept the fact. I mean, what is wrong with that? I do not find anything wrong. After all, the central bank will have to inject liquidity to support growth, and the injection of liquidity cannot take place through the forex tab. So, if it has to take place through the bond tab, there is nothing wrong. We do not need to feel embarrassed about it at all. That is my contention.
Sir, what do you feel about the state government borrowing? Now, shall we go to state government?
Yeah.
So, state government borrowing, if we see, they have started borrowing huge amounts.
Yeah.
And what they were in all these years. What we are seeing is that, despite their fiscal health, some of the fiscal health is not, obviously all states are not equal, but we see that all of them are going at the same rate. Why is it that despite there not being in that particular health, I mean, say like you have Gujarat and Tamil Nadu and say maybe Assam and Madhya Pradesh, they'll all go in a similar band. Why does that pricing happen in such a manner?
Poonam, to confess, I really don't I don't have a very clear answer for this question, because this is a wonderful question actually. But let me try inventing an answer for this question.
Okay.
Now, first of all, in a market driven scenario, clearly, I mean, I am just taking the example of Tamil Nadu or Gujarat or Punjab. I mean, they have to be rated higher compared to a Bihar government, which could be running a higher, I mean, again, Bihar I am taking as an example. Please do not take it that I have any kind of a negative feelings about Bihar. I am only saying that one state government could be conducting its finances far better, another state government may not be conducting its finances well. So, clearly the market would have to differentiate. Poonam asked the right question, why is the market not differentiating at all? Now, one important answer for this question is, there is an implicit guarantee for the state government borrowings. Is it stated anywhere in writing? No, nowhere. You will not find it in writing anywhere at all. But if you look at one of the constitutional provisions, state government will have to take the permission of the central government to go and borrow in the market actually. So, by giving permission to the state government to borrow, there is an implicit assurance on the part of the central government that fine, you go and borrow, your finances are good, so I may stand behind you tomorrow if there is a crisis. So, this the market is taking it as a very, very positive gesture on the part of the central government. So, it is treated as a kind of a quasi guaranteed bond. So, every state government bond is considered as a quasi guaranteed bond, and the pricing is nearly similar, and the pricing is more dependent upon the prevalent liquidity condition rather than the credit at all. Let me come to another point. Let us assume, again I am taking the name, Tamil Nadu government is not able to service the debt of one of its securities. Can the central government be a mute spectator in that scenario? Maharashtra government is not able to pay back the principal and security. Can the central government stand as a mute spectator there? My assertive and categorical answer here is no. Central government cannot adopt that stance at all. A sub-sovereign in India, if it is going to default, it is going to cast a huge shadow on the sovereign borrowing itself. It is not that the shadow simply goes away. if not affecting the central government borrowing. So, clearly the central government will have an interest in ensuring that the sub-sovereign is going to service the interest as well as the principal at the appointed time. There is an automatic debit mechanism also available within RBI, which will ensure that debits are done and the interests are serviced and the principal is going to be paid back. So, these are mechanisms which are going to be in place, which is giving a lot of confidence to the market to price all the state government securities alike. But Poonam is very right in her questions. When the credit quality is completely different, the market, by not pricing the bonds on credit quality, I think perhaps the market is not doing a good thing at all.
So, but that is a very insightful answer, that the shadow doesn't go off. It's
Yeah.
like, you know, if somebody in the family defaults, the whole family gets a bad name.
Yeah, right.
So, something like that. So,
Yeah,
obviously,
exactly.
somebody, the elder will step in and say, "Ki, okay, I will give you on his behalf."
Yeah,
So, it's
right.
something like that, the central and the state.
Absolutely.
So, yeah, I suppose so. Sir, another question which we had was that what happens, should RBI also intervene in the GSEC market, like how it does in the forex markets?
Actually, as long as I was managing the treasury in RBI, there were a lot of questions asked of me. You guys jump into the forex market the moment the rupee depreciates, but you are a mute spectator when the RBI, when the bond actually the yield simply spurt and you don't step into the market at all. I kept asking the question to myself, I mean, what is the difference between the two? Why is RBI not managing the interest rate? I mean, it need not micromanage the interest rate, but when there is a hard spike in the interest rate, can it not provide a cushion as far as the market rate is concerned? When I used to give a theoretical answer in many of these conferences, saying that interest rate is a kind of a very sacrosanct variable, which RBI would not like to touch even with a barge pole, people used to laugh at me. And people who are bold enough, they used to come and criticize me on my face. Well, I know that you guys, when you do the open market operation, you have the yield in mind, you don't have the liquidity in mind at all. Now, I cannot completely refute that criticism. Let me tell you that I cannot completely refute that criticism. There's yield also plays around in the minds of RBI, while it may not be the determinant factor as far as open market operations are concerned. At the same time, let me just put Poonam's question in the right perspective. I mean, what is so sacrosanct about the interest rate that it is not so sacrosanct about the exchange rate? I don't have an answer for this question at all. I would say when a central bank conducts a monetary policy, exchange rate is also a very important and a critical economic variable. Now, there are central banking authorities like Monetary Authority of Singapore, which has the exchange rate as an anchor for conducting the monetary policy. I mean, how can you say that the exchange rate is something which can be managed by the central bank, but the interest rate cannot be managed at all? So, I would say, while the central bank need not soil its hands completely managing the interest rate, because particularly in a country like India, India is a debt manager for the government of India also. So, it will smack of conflict on the part of the government. What Reserve Bank could do is, there is an NDS home terminal that is available within RBI. Quietly, you can go and sit in the NDS home terminal, buy and sell the government securities as and when you find it convenient, and if it can move the market by a few basis points, it can comfort the market that there is a buyer emerging and it is not a completely buyerless market. Perhaps Reserve Bank will be doing a good job. It will be doing a yeoman service to actually turn around the speculative motive, which is actually getting deeply entrenched in the market. So, to that extent, I would say RBI should intervene, although not to the extent that it is doing in the foreign exchange market. But let me tell you, this will not please any economist, this will not please any theoretician who is actually quite tuned in his mind that RBI should never intervene in the bond market.
So, they do sometimes. There are sometimes you can see that, you know.
You are
RBI is a
right, you
little
are
bit-
right. And that is concealed under the
Others,
Clearing Corporation of India general head called others.
yeah.
It does not say whether banks have bought it or something. RBI, while it is a giant in the market, when it goes and does the NDS home operation, it comes under the very I mean, decrepit name of others actually, so that nobody knows that RBI is bought in the market.
Sometimes it can also help in, when there are off the run and on the run bonds.
Yeah.
So the spreads can compress a little.
That's, I think, I think, Poonam, you should elaborate this point. There's a beautiful point you are making. I missed out. Please elaborate that.
No, I mean, in the sense that so many times when it becomes off the run bonds may be 20 basis, over the on the run bonds. So those kind of mispricings, if the RBI does, a little intervention, it will bring a lot of, pricing correction happens. So it's a small amount which the RBI needs to do, but it will bring a lot of correction in the market.
Absolutely. When you are going from a old 10-year security to a new
one.
10-year security, suddenly it becomes so jumpy that almost about 20 basis points sometimes separates the
20,
two
25
security.
basis points.
So what Poonam is suggesting is perhaps a little bit of NDS home operations at that time on the old security as well as a new security will actually even out this differential actually.
Yes, yeah, sometimes even, sometimes they are large, big coupons, and the banks, like say investors who want to just kind of throw out that security for whatever, it's a family silver or whatever else, and there are no buyers for it, and they sell it off.
Yeah.
So, suddenly you find that, the gap is huge. You may get a 50 basis gap between the
right.
on the run and off the run, because maybe that is a high coupon and the banks don't want to buy a high coupon bond or something like that. There are no buyers for that. It's a liquid paper.
Yeah.
So the RBI can, help out in those kind of a situation where, it will at least reduce the gap between the spreads.
No, no.
That is a window.
See, what she is talking about is a transition from a new 10-year security, a old 10-year to
10-year
new
to a new,
10-year.
huh.
In fact, there is an idea that I am getting now, so I will start using it in the conferences without taking your name
No
actually.
problem.
Yeah.
Sir, now this is, since you have also been in SEBI, so I will catch you on corporate bonds as
Okay.
well. So, with the 81 bonds, if you have seen, Yes Bank, the 81 bonds took a huge beating, that, suddenly people saw that a bank bond has become zero,
Yeah.
right? Nobody thought a bank can ever go bust, or
Yeah.
a bank bond can become a zero. So, in this case, now, so suddenly we saw that yes, 81 bonds are prone to a lot of risk. In fact, in insurance, the IRDA has called it as equity, has
Right.
termed it as equity.
Yeah.
Now, what has happened in the new scheme of things, like after, I think there were a lot of call options. So, a lot of banks have again reissued 81 bonds, like say SBI had issued, I think, at 75 basis over the tenor. Now, the spread is too less to commensurate with the risk.
And the risk what we have seen.
Yeah, the risk that we have seen currently. Why the market? I don't know, because a lot of people approached me, will you take, I mean, they're all good banks like say SBI or say HDFC or others, but at 770 or 775, it's a no-brainer to buy it actually. I don't want to buy it.
Yeah.
It's a clear no from my side, because if I see, even if I look at it as an equity for 5 years, if I put it in the equity market, it will at least give me 10 or 12%, at least 10%, if not 12%, then why should I get 775? So, if I look at it from the equity side, if I look at it from the debt side also, it is not a very great instrument, because the spread is not commensurate with the kind of returns. The 10-year is only giving me 730 or 735.
Yeah.
And this is a 81, so it doesn't have, it's a perpetual bond,
Yeah.
right? So, sir, what is the reason for this? I know, I mean, you are not an investor, but
I am not an investor at all in the 81 bonds.
Sorry.
I will have to take at least about 2 to 3 minutes if time permits on this particular question, because this is a very important question. First of all, I completely differ with RBI as far as the Yes Bank situation is concerned. While the bond had a covenant which very clearly said that at a point of non-viability, PONV we call it, the bond can be completely written off. But I would say it is absolutely antithetical for any accountant to think of a bond holder standing in the queue behind the equity. I find it just not acceptable at all. Now, the covenant was there, people took it as a very normal thing, people never thought this bond is going to be written off. Reserve Bank really sprang a surprise. I mean, it bombed the entire economy and the bond investors by saying that I am going to write off this 8,500 crores of bonds actually. I would say, first of all, that covenant does not fit in with an accounting tenets at all. it should have been at the worst case scenario converted into equity. You convert that into equity by having a suitable covenant that you will stand on par with the equity holders, you will not get the money back at all, it will be converted into equity. Having done that, I would say the landscape for the AT1 bonds became very highly risk prone, with the investors feeling that if the bank is going to come under any kind of a pressure, the bond is going to be completely written off. Now, I was thinking that this particular bond is going to die a natural death in India after the Yes Bank bonds were written off. But as Poonam rightly pointed out, the bond is not just dead, it is alive, it is kicking, it is running around with huge amount of energy. So, I am wondering actually what is happening to this bond market at all. Now, this is something where actually the market is having the feeling that the bigger banks in India which are floating it, for example, State Bank of India, Bank of Baroda, particularly the public sector banks, I do not think the government will ever write off these public sector bonds at all, because it is going to be again a bad name for the government, it is going to be a bad name for the RBI. Now, they could do it in the case of an Yes Bank, but to do it in the case of a bigger bank is just not going to be a done thing at all. So, while the market has learnt a bitter lesson from the Yes Bank episode, they are still looking at the practicality of this bond being written off. If it is going to come under, if the bank is going to come under some pressure, the bigger bank coming under some pressure. So, people think all said and done, this is going to be a kind of a big bank bond. It is not something which is going to be written off in a jiffy like the case of Yes Bank. So, the pricing people want to give it is just about 30, 40, 50 basis points over the 10-year. People do not want to price it beyond that at all. That is the pricing kind of a mechanism which is prevailing in the market. Unless the government is going to take a very drastic step of writing off one of the public sector bank bonds, I think the market is not going to learn this pricing lesson at all. That is what I feel. And SEBI looked at it from a different perspective. SEBI thought the pricing mechanism is always linked to the first call. I mean, this is ridiculous. Why should you always say that the call is going to be exercised all the time? So, SEBI came out with another extreme circular, treat it as a 100-year bond. I won't accept that circular, but then SEBI thought that if market is going to err on this side, let me just push the market to the other side. They tried calling it as a 100-year bond. I would actually veer around to say that, in fact, an economic argument here is no bank could have left it as a perpetual bond. If the bank wanted to be alive in the landscape of AT1, and AT1 is a very important landscape, they want to raise further finances in that, they can't say that I am not going to pay back, I am not going to exercise the call. If not the first call, the second call or the third call they would have exercised. So, that is how the market was trying to price it that way, but SEBI got very annoyed by that kind of exuberant pricing that the market was doing.
I think we're running out of time, sir. So
yeah, we are run out of time by at least 5 minutes minimum.
So, we'll have to wrap up this, sir.
Yeah.
So, it was a nice, excellent conversation that I had with you. I have learned so much, and I'm sure the audience would have learned even 100 times more than what I would have learned. So, really, it was really a pleasure, sir, speaking with you and learning so much.
Thank you very much, Poonam, for all those very important questions, particularly the question on the old 10-year and the new 10-year, which I will continue to remember.
Thank you,
you.
sir.
Yeah.